welcome to the Maine Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main, president of Main Financial Group, as well as joined by Adam Freund, CRC at Main Financial Group. To our viewers at home, a very special episode for you today. We have a lot of viewer questions to get through. And first of all, we want to say thank you for always sending in your questions. We know that you have a lot of things on your mind that you want to ask Jordan and Adam. So stay tuned, folks at home. This show is all about you. It's for you. And best of all, your question could be answered on today's show. Thank you for being with us. Jordan, how are you today?
I'm cautiously excited because we never know what we're going to get with these email shows or the questions, but there's always a few. Usually Adam gets the blunt of it, but I'm excited to be here. How about you, Cynthia?
Very excited as well, because this show is amazing. I love viewer questions, so thank you so much. And Adam, how are you? You're looking around, you're thinking.
I was just wondering if I could leave before the question comes up.
No, you have to stay.
Darn it.
Because I know there's questions in here that are just going to be for Adam. I bet.
That's right. Yeah, probably will be.
Well, before we get started, because I know a lot of us talked about this today at lunch, so I'm going to put it out there again. In your opinion, where is the best pizza in Detroit?
Buddy's Pizza. Well, you know, Cynthia, since you're not from Detroit, what Detroit-style pizza is. It's the sauce on top.
Okay,
Well,
so the
thick.
cheese is
And
the
thick.
layer underneath and
so
the
it's
sauce?
like deep dish, but with the
Oh,
sauce on top.
That
Now,
sounds good.
Similar to Chicago, but not exactly.
No, not at all. I mean, yeah, it's square. It's done in a certain type of pan, so that basically, if you eat one slice, it's a loaf of bread.
Yeah.
So not to me is that is not the best pizza. There's
Oh.
a place called Novella Pizza in Milford. Yes, a free
Okay.
plug. That makes a what they call a Chicago tavern pizza.
Okay.
Which is a very thin cracker-type crust that has the cornmeal on the bottom. But I always think a good pizza has three main things that need to be good: the dough, the sauce, and the cheese.
It's
And
true.
You get those three combinations, everything else can work. And that place in Metro Detroit in Milford is very, very good.
They
Now I'm
both
hungry.
sound great.
Now, what about down in where you live? Is there a good pizza joint?
Yes, we have a ton, but I usually make our own homemade pizza.
Ooh.
Every Friday night is pizza night. And so it's always something with vegetables and cheese, much to your point. But if you get those things right, I like an olive oil base. I don't do a lot of the red sauce. If I make a big pot of sauce for pasta on Sunday, we'll sometimes use that the following Friday. But overall, just olive oil. So I'm not going to say we have the best pizza in my house. I don't want to say
Well, is it in a pizza oven? Do you have it?
No, it's just a regular oven. And so it just bakes so beautifully. And I just do a little garlic salt on the top and olive. Now that we're all hungry.
I know, this sounds very Italian as well. You know,
Yes.
if we look at your last name, right? So,
Yeah.
so we've got pasta, olive oil, pizza. Let's go down to this.
Yeah, I
I'm
was gonna
hungry
say,
now.
when are we-
Okay.
No, I'm
That's
sorry.
it. We're all
Bye,
finished. We're
everybody.
gonna go
We're
eat.
traveling down to North Carolina.
Well, I am so excited. Let's dive right into these viewer questions. We have John actually from East Lansing. Hi, John. Thank you for this question. It says, I'm 61 and my wife is 60. We've been doing small Roth conversions each year since 2021. With the new tax law changes in 2025, excuse me, still a smart time to convert, or are we better off pausing until things settle down?
Absolutely no pause. Definitely convert. Well, first of all, John, I wore my Michigan State tie here, and he is from East Lansing. So
Yes.
way to go green, John.
white, yeah.
We have a great tool for you, John, online. It's a tax calculator, and it will answer your question for you, so you don't have to take our words for it. You can go right to maintaxbill.com, and all you have to do is put in your age, the amount of money you have in these pre-tax IRAs, 401ks, and such. You get to pick a rate of return that you want to plug in for the analysis, and pick a tax rate that you think you're going to be at. And it will show you that if you wait and don't convert, how much you're going to pay in tax versus if you convert now, what you'll pay now to get into that tax-free Roth IRA. So great question. I would highly urge you to go check out our free tool calculator online.
And I think he thinks that at the end of 2025, the current tax bracket sunset, but we know the OBBBA, One Big Beautiful Bill Act,
Yes.
actually extended those tax brackets. So While I agree with Jordan, absolutely, go to our site, get that information. It's getting towards the end of the year, so it might be tough to do one in 2025, but definitely 2026, 2027, 2028. Convert, convert, convert. And kudos to you for putting money into a Roth.
That's right. Good,
Most
good,
definitely.
good job, good start, but keep it up.
Yeah, since 2021, so that is a great job. Let's go on to the next one. This is actually Sarah from Troy, and she writes, I'm 67 and retired last year. My bank advisor moved half of my portfolio into bond funds to protect me, but my bonds were still down last year. How can something meant to be safe lose money when I need income? Great question.
Yeah, so
Yuck, that's all I can say. Bond
Yes.
funds, yuck.
So bond funds, unfortunately, are essentially mutual funds. They are mutual funds. And just like any mutual fund that is tied to the market, it is going to go up and down as the market sees fit. The old adage was that you put some money into stocks, some money into actual bonds, not bond funds. And therefore, there is a bit of safety there. Your advisor, I don't think, is trying to mislead you. I just think is not educated enough to know the difference between that. I would say that there are other pressures too. As interest rates come down or go up, that can affect the bond markets as well. So to be perfectly frank with you, or Adam, with you, is that you're still not you're still susceptible to whatever the market is dictating to you. And if that's a problem for you, if you do need to have some protection against risk, you need to seek some other opinions elsewhere.
Yeah, and the simple answer, that was a long-winded answer to the question.
Yes.
The simple question is, a bond mutual fund is buying and selling bonds before their maturity.
Yeah.
Okay.
And so if you have a bond that is 8%, that's a good bond. And let's say interest rates have gone down at only 5%. So that new bond is only worth 5%. Boy, you can sell that bond at a profit.
Right.
So that bond fund is going to offload that bond and make the margin. It's called a premium they sell it at. Vice versa, if you bought a bond at 5% and now existing bonds are 8%, that 5% bond is a dog. You have to sell it at a loss at a discount.
Wow.
So there are two things. It is tied to the current bond market and the interest rate market, but these funds are also buying and selling bonds. They don't hold them to maturity. So you got two things going on inside it. It is, when you see the word fund, that means there is risk, right? So it's maybe is not as much risk as a straight stock or an index fund,
Right.
but there still is risk in that. We get this question all the time. Versus if you just buy an individual bond, General Motors, Ford Motor Company, whatever, hold it to maturity. There's no risk as long as that company doesn't go out of business. Obviously, we had the issue with General Motors did go bankrupt many years ago.
Enron.
But that, you wouldn't see the fluctuation from that standpoint.
No, not at all.
But it is a great question, and there are a lot of other tools out there that can give you that safety feeling and accomplish your goals that you probably haven't looked at, that your advisor hasn't shown you.
No. That's exactly
I think one
right.
of the greatest tools, Jordan and Adam, would be the RIPT report. And I know that you have a very special message, Jordan, to the viewers at home. Talk about what that is, please, before we take our first commercial break.
Yeah, our offer today is for anyone to come in for 2 meetings out of their life, and we're going to give them 2 free things here. So the first one is your own personalized written financial plan. We call it our RIP report, this analogy, RIPT. The first is risk. How much risk are you taking? Are you driving your portfolio as fast as you want or as slow as you want? The I is income. What if I screw up and live too long? Do you have a written income plan in retirement, or is it more of a guess? We can put a written plan together for you. The P is portfolio health. Have you stress tested that portfolio? What are you paying in fees? How have your returns been? The T is one of my favorites, is Uncle Sam taxes. Have you put any creative strategies into place to get Uncle Sam out of your retirement plan? We'll give you a customized report for your situation, as well as throw in a copy of our new book, Main Street Millionaire, how real people build real wealth and keep it. And we'll give you both of these if you can just come in for 2 nights. Call the number or click the QR code.
There you go.
Jordan, thank you so much. Adam, thank you so much. To the viewers at home, the number to call is 888-462-7839, 888-462-7839, or you can grab your smartphone and click on the QR code at the bottom corner of your screen. That's going to put you on the fast track at Main Financial Group, so you can schedule your appointment accordingly. We're going to take a very short commercial break. We have so many more viewer questions to get through, so bear with us. We'll be right back momentarily. Here we go.
I started out actually going to college, and I was going to be a music teacher. I realized very early on, like at the end of my first semester, that it just was not for me. Fast forward many years later, my parents are educators. My dad quit being a teacher and became real estate and commercial real estate. And after I graduated college, I decided I would go and work for him. And what I really liked was helping people make money. And I realized that that was more my calling than actually selling real estate. So I ended up getting into the financial advising world. It was a big jump, but it was the fact that I was going to be helping people rather than selling people. And that makes a huge difference in my mind. I have enjoyed it tremendously. When you can tell a client, hey, guess what? You can retire. It's one of the best days of my life right there. It's not about my goals. It's not about my office's goals. It's about their goals. It's their money. We need to educate them in order for them to continue to live in a manner of which they become accustomed. Selling is terrible. Educating, getting people to understand why we need to do it this way and consult with them, that's the way to do it.
Welcome back to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main and Adam Freund of Main Financial Group. And if you're just tuning in for this second segment, this show is just for you today, viewers at home. These are your questions, so thank you for being with us. We could be tackling yours next. Without further ado, let's keep going. This is Eric and Pauline from Brighton. They would like to know, my husband is 62 and wants to file for Social Security now. I'm 63, and I think that waiting is better. We have about $1,900,000 between our 401ks. How do couples decide when to take benefits? It's a great question.
That's a
Great
great
question.
question. Jeez.
I'm going to talk about my situation.
All right.
Everyone is different. So in my wife's family, everyone lives to be 100. In my family, we have trouble making 70. So we may make some different decisions, Emily, my wife and I, on when we decide to take Social Security and not, because the spouse collects half of the remaining, or the higher of the two, I'm sorry.
Of the two, yep.
So we're going to look at Emily's versus mine, and we may turn on one and defer another. So there's different strategies you can do. So it isn't a one size fits all, but you also have to take into consideration your life, your standard of living.
Right.
Right? How much income do you need? What other sources do you have? Do you have a pension? Some people still have those old things, right?
That's true.
I would love to have a pension anymore. You know, do we have taxable IRAs or do we have tax-free Roths? All of that needs to be coordinated in an integrated plan for your income. I just think it's a great question. We get it all the time, but it can't be answered in a minute on television.
The only thing I want to add to that is we know at this point right now that the Social Security Administration says by 2035 that they are going to reduce everybody from soup to nuts. If you've been on it for 2 months or 20 years, Social Security by, I think it was 17%, just to keep the Social Security going. So that's basically a Band-Aid over a bullet hole, right?
Yes.
But if that's the case, we have been looking at in people's situation. Are they still working? Aren't they not still working? That maybe taking it earlier is the right choice to do because of this whole idea that in 10 years.
Yeah, some people turn it on, take it early, and even if they're still working, they're going to pay back some until they get to maximum retirement age.
Yep.
And that may be better than the
17% reduction.
What's the opposite? Yeah, reduction. I would say not raise, but reduction.
Yes.
So there are a lot of things. So that's a very deep question, great question.
Yeah.
But I think that there's several other things that need to be put into consideration.
Yep.
Most definitely. Let's move on. This is Megan. I'm trying to get as many as possible. This is Megan H. from West Bloomfield. My husband and I are planning to retire next summer. We're both 66. The market keeps bouncing around and we're worried the timing is wrong. Should we push retirement back? Great question.
Yeah, this is a great one. That comment shows us that there might not be a lot of tolerance for risk in that household.
Absolutely.
And so it's imperative to understand what your risk level is. If you don't, we've got a great website and an 11-question survey.
11 questions.
It's mfgrisktest.com. You can take a quick multiple choice, 11 questions. It'll take you 60 seconds or less, and it will give you a score of 1 to 100. That's how fast you're driving. So if you're a 25, you want to go slow, and that means only 25% of your portfolio should be exposed in the market, 75 in protected vehicles. If you're a 50, that means you like to drive on Grand River, half and half. And if you're an 85, that means you want to be on 696, and most of it should be exposed in the market. Based on this comment, you're probably under 50.
Yeah.
But take the test on your own and see what your score is. But then make sure you implement that as part of your income plan. So risk first, then income plan, and then the overall portfolio allocation. So I know we're in 30 seconds trying to diagnose a financial problem here, but I think that risk assessment can get them going.
I think risk assessment, and also you need a plan. It tells me that they don't have a plan.
Yeah.
Because the fact that they're already worrying about this and they're looking forward, good for you, you're looking forward, but they need a plan.
Yeah, and congratulations on upcoming retirement.
Yeah,
That's one
absolutely.
of the biggest accomplishments we see on a daily basis, but make sure you plan for it. A goal without a plan is just a wish.
That is so true. Very, very true, gentlemen. This next one, this is Steve P. from East Point. He writes, I'm 73 and taking RMDs. My advisor says that I'm in a moderate portfolio, but my account dropped almost 8% last year. Isn't moderate supposed to mean less fluctuation?
Well, Steve, that really depends. And while your portfolio may have dropped last year, we're going to assume you're talking about 2024. The market was up last year.
Whoa.
Right?
Yeah, it was.
Yeah.
It was up nicely.
It was up nicely. So to me, this sounds like there is really something's not going right in your portfolio. I would definitely have somebody like us take a look at that. I think for your situation, we use a company called Morningstar. They're the J.D. Powers of our industry. They don't care what you're invested in. All they want to know is how many shares you have and the symbol of that particular investments or those particular investments. They give us a report back that tells us what it's being compared to, what kind of index. So an index would be like the S&P 500, the Dow, the NASDAQ. And the mix in there, and what sectors you're in, and the fees that you might be paying, and whether or not this is a passive or active investment. It sounds to me that it's not only passive, but it could be very conservative.
Yeah, he needs benchmarks to be able to evaluate. Compare it to a benchmark. A benchmark is an index. You know, you've got the S&P 500, the NASDAQ, all of these things, the Dow Jones. You have to compare your portfolio's performance to that benchmark to evaluate if you've done a good job. Looking at, say, if you lost 8% in a year when all the indexes were up, that is not an actively managed portfolio, and that is not good. So Adam's right. Use some independent people like Morningstar. Come see some fiduciary advisors like us. But I think there's definitely a need here.
Yep.
Most definitely. And I want to get one more in before we take our next commercial break. This is Carol from Canton. She writes, I'm 69 and my IRA just crossed 2.1 million. My accountant mentioned that I should prepare for bigger RMDs. Does that mean I'll be paying higher taxes for the rest of my life?
Okay, Jordan.
Oh boy, we call them tax bombs, and every time we put another zero behind an IRA, there's just more tax that we're going to have. And the accountant is right. These RMDs that kick in at 73 and above, depending on how old you are, especially when you're in the 7 figures of IRA balances, it's going to trigger 6 figures of tax. It's going to tremendous amount of tax. That's why we really consider Roth IRAs as an alternative. Take a look at our tax-free our free calculator online. It's called maintaxbill.com. This is Carol, right?
Yep.
Carol,
Yes.
go to that and you can plug in your amount of assets, the pre-tax retirements that you have, how much you think you'll get in rate of return, your tax bracket, your age, and it will show you how much that if you don't convert, you're going to pay in total tax versus converting. It might be worth taking a major chunk of this in 1 year, biting the bullet, and converting things to a Roth and paying some tax, but then never again you'll be paying, there won't be any RMDs on a Roth IRA.
Okay.
So a lot of people think if I got to 70 or how she's
69.
69, that I'm too old to do a Roth conversion. Absolutely not, especially when people are living to be 100. I think a Roth IRA is something that you seriously should consider.
And if you don't know what tax bracket you're in, talk to your CPA. He will tell you what, or he or she will tell you what your tax bracket is. Yes.
Gentlemen, thank you so much. To our viewers at home, there's a number for you to call on your screen. That number is 888-462-7839. What you're calling in for today is the complimentary consultation with Jordan and Adam, where you're going to have your very own RIPT report customized just for you. Once again, 888-462-7839, or grab your smartphone and click on the QR code at the bottom corner of your screen. That is the fast track to get on the schedule at Main Financial Group. We're going to take a very short commercial break very quickly. We want to get through more viewer questions. We'll be right back. Stay tuned.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main and Adam Freund of Main Financial Group. And viewers at home, this is your show today. These are your viewer questions. So here we go. This is Eddie, age 10, from Livonia.
10?
Right? Hi, Adam and Jordan. I watch with my dad every Sunday. Jordan, I love your ties. And Cynthia, I think you are pretty. Aww. I have two questions for Adam. Here we go. Adam, number one, why is your forehead getting bigger every year? Number two, did it stop growing or did your hair just quit?
I like
Listen,
this kid.
Eddie.
I like this kid.
Listen, Eddie, I knew that this was blacked out on my piece of paper for a reason. So, Eddie, you're very funny, aren't you? Well, just remember, when I was your age, I had a full head of hair, just like you, buddy. I don't know who Eddie is. He might be bald. So,
Well,
next.
I think he sounds sweet.
Oh, yeah.
I'm sorry.
Well, because he gave you a
He
compliment.
did. Thank you,
I like
Eddie.
Eddie. I like Eddie. Call me anytime, Eddie.
Right? I mean, oh, okay. Let's keep going. So here we are. This is Lisa D. from Farmington Hills. And she writes, my mom is 82 and her advisor barely calls her back. She's afraid to move her accounts because she thinks it will trigger taxes. Is that true?
No, not at all. But it's a great question and a great fear and a great misunderstanding. You can do a lateral move to another advisor. We use both Fidelity and Schwab as our custodian, so we let clients choose which one. Everything comes over as is. So Cynthia, if you have 100 shares of Apple stock over at your other brokerage house, 100 shares of Apple stock come over to us at either Fidelity or Schwab. There isn't a taxable event. It's called an ACAT transition. So that is one thing you don't have to worry about. But I would be concerned with your advisor not calling you back and not planning with you, because every year life changes for you and your plan should be constantly updated. Life throws us curveballs. We get older. Our views might change. Our wishes might change. We have one client that every month disinherits and reinherits her one son that she's mad at. So we're like, okay, what is it this month? And so I think having a working relationship, a fluid relationship with your advisor is more important than anything.
And I think seniors deserve a little bit more communication, even more than once a year. This is something that we pride ourselves on, and to make sure that the people that that need that communication get it.
Absolutely.
Yeah.
Absolutely. Let's jump into this one. This is Paul from, I hope I say this right, Okemos?
Okemos.
Oh, good.
Very good.
I'm 61 and planning to retire in 5 years. My 2030 target date fund in my 401k dropped more than I expected. Are these funds actually good for people close to retirement?
Well, in a word, no. We don't like the 20. We don't like the number funds, as we call them.
Target funds.
The target funds. We see these all the time in 401ks. It's really an easy way for them to kind of
Make more.
and to give people an easy choice.
Yeah,
right?
it's just for the lazy investor that says, I don't really know how to pick these mutual funds in the 401k, but so this is like a fund of funds where it'll take a combination of things that are already offered there. So it does the allocation for you, but then they can add another layer of expense in there. So the target funds are really only for people that don't have an advisor.
Right.
For us, for all of our clients that are still working, every quarter they send us their 401k statements, and we give them our opinions on which funds and how they should select them. So they can go right in, log in, and do their own allocation, but with some of our guidance on that. So I think the targeted funds are a bit of a, not a scam, but I just don't think they're worth the value.
They're just lazy.
They're lazy.
They're lazy. Okay, let's get one more question in before we have to
Okay.
close. This is Denise from Royal Oak. My husband and I keep about $350,000 in cash because the market scares us.
Ooh.
We're 68. We're already retired. Are we being too cautious?
Boy, that's a hard for a quick answer too. That's hard to answer because we don't know their full situation. 350 could be too much. 350 could be just right. 350 could be not enough. Right? So we don't know your situation. I always call it sleeping at night money in the bank. Right? Anything. It doesn't matter what kind of interest rate you have. If it's keeping you. Or you're able to sleep at night because you've got that cash in the bank, that could be the right amount. We don't know. I would say that you need to come in and see somebody like us to kind of give you an evaluation as to what it is that we could do. We do know that we can get better interest rates than the bank.
Yeah.
But this is something that we can't really answer on television, unfortunately.
No, they need to come in and have a
Yep.
meeting. And Jordan, you have a very special message that talks about that.
Yeah, we would love to see you. We're going to give you 2 free items here: your own personalized written financial plan, the RIP report, risk, make sure you're driving as fast or slow as you want, an income plan, not an income guess, a written income plan, a portfolio snapshot, a health of your portfolio, and a great tax plan, and we'll throw in a copy of our free book.
Jordan, thank you so much. Adam, thank you so much. To our viewers at home, thank you for the viewer questions. Thank you for always writing in. That number to call is 888-462-7839. What you're calling in for today is a complimentary consultation to have the RIP report customized for your specific needs. Once again, to get on the fast track, grab your smartphone, click on the QR code at the bottom corner of your screen. Be safe, be happy, be blessed. We'll see you back 1 week from today on the Maine Money Show, where Wall Street meets Main Street. Take care.